Welcome to the Balance Sheet, where you can rise above the noise and learn about the most important business issues of our age. I'm your host and fellow student, Conrad Chua. Private markets refer to a wide range of assets that form a huge and growing part of the global financial system. Today, we have someone to help us make sense of all this. Angela Lai is head of APAC and valuations at Preqin's Research Insights team and covers the private investments industry. She has over 15 years' experience in investment analysis and risk management across asset classes in public and private markets, specializing in the valuation of private equity and private debt assets. This includes distressed and special situations. Prior to joining Preqin, Angela worked for Deutsche Bank, OCBC in Singapore, and Macquarie Capital in Japan. So, welcome, Angela.
Hi, Conrad. Thank you very much for having me.
Angela, could you start by telling us what are private markets and what are the main asset classes?
Sure. So, private markets, first of all, is very broad. I'm going to focus on what we call alternative investments, which also is very broad because these days alternatives could go from things we're more familiar with. What I have here, private equity, venture capital, that sort of thing. But nowadays, you've also got the cryptocurrencies, NFTs, wine, luxury handbags, and everything that is not traditional could be considered alternative investments. So since I work in Preqin and we are one of the most comprehensive providers of data for the private capital alternative investments industry, I'm just going to show you some of the data that we have, all sourced to Preqin, of course. So according to the way, the data that we have, we look at private capital alternative investment market for six, seven asset classes mainly. So it's around the $12 trillion industry now, measured by asset under management, and majority of it sits with the private equity strategies. So around 60% is in private equity, including venture capital, which is a subset of private equity. And then you have slightly less in the closed-ended funds in real estate. So this is different from, like, let's say, REITs or open-ended REITs. And then we also have some in private debt, we have some in infrastructure, and we have a small amount in natural resources. So that's sort of the main alternative assets that we would be talking about, especially when it comes to institutional investors. That's the kind of alternative that they would be referring to.
And you mentioned institutional investors. What kinds of institutional investors would invest in these alternative investments?
It's also quite broad, but I would say the major types of institutional investors that we deal with would include pension funds, for example, government and private pension funds, insurance companies, as well as sovereign wealth funds. Some banks also allocate to alternatives, and let's say fund of funds, so funds that allocate into these alternative funds and manage it as an investor for other investors. So we have a good variety, and I think now there's a bit more of talk, a little bit of like a beginning of a trend of the democratization of private capital investment. So we have got more well, starting with the more high net worth individuals in the private wealth segment, like family offices, but then I guess slowly, a lot of platforms, a lot of fund managers are also working on the smaller segments, more mass market segments. But that's really just, right now it's quite nascent. It's really just seeing the beginning. So mostly, this is a very institutional investors world so far.
Mm. And for those who may not be that familiar, what is a family office?
Well, a family office could have a single family office, whereby you might have very wealthy families trying to plan for generations to to continue with the wealth, continue to build on their wealth. So that usually would be a single family office. But nowadays you also have multi-family offices. So those tend to be more institutionalized, and it's managing assets for different families.
Mm. And can you give us a sense of how large the global private capital market is, say, compared to the public capital markets?
Yeah, that's a very interesting question because despite that the global private capital markets has really grown a lot, it is still a very small percentage of the public markets. If we take, for example, venture capital and private equity, we add it all together, it would still represent only maybe 5 to 7% of public market cap. Maybe a little bit higher in North America. Maybe that's maybe like 7 to 8%. In Asia, maybe just 3 to 4%. Getting better, maybe 5%. But there's still definitely a lot of room. Public markets still continue to be the more dominant piece where I guess the mass market and also very large allocators are still able to access.
You have this radar chart on the right hand side, uh, showing main reasons for investing in alternative assets. Could you talk us through that chart?
Yeah, I'm showing this chart because I think it's good to try and understand, well, it helps to understand the differences between these different asset class, and you could tie it back to the goals of the individual investor. So in this radar chart here, we have the different reasons where investors, that form the key considerations for investors when they allocate to certain asset classes, and the different colors here represent different asset classes. So, I mean, for example, I would say that private equity and venture capital, they are very illiquid asset classes. And basically, what you're doing is you're putting money into, could be a very early stage company, especially in the case of venture capital. You don't even really know if the idea is viable, if the model is viable, if the company is going to survive. So you're putting money there, and you're going to have to wait a long time to, there's a long incubation period. You're going to be waiting for several rounds of funding. And then, so we did some studies, and we find that, to go from a very early stage, like a seed stage venture capital investment, to the final exit, where you get your money back, on average, it takes 6 years. But that's really on average. That's for successful investments as well. Sometimes if you're not successful, loss ratio could be quite high. It's a very risky asset class as well. So you could definitely take a significant loss there. Or on the other hand, for very successful ventures, those with incredible investment multiples, let's say, I don't know, the Facebook, before Meta, it was more like 7 or 8 years. So we can have, it's less predictable in terms of when you are going to recover that investment, and how much you're going to recover from it. Could be a lot, it could be very little. And so it's an asset class where you must be willing to take the risk, and you would understand that it's also, even if it's a successful investment, you would likely have very little liquidity in between. And so, reflecting this on the radar chart, so this comes from our surveys to investors, you would see that when we look at the lines for private equity or venture capital, you would see that very few would rely on it as a reliable income stream, because it is really quite uncertain as to when you can really get your money back. And usually in between those 5, 6 years, you are unlikely to get very much distributions, because you want to maximize your investment. Even if there are distributions, you're quite likely to reinvest it into the company. On the other hand, if we think about asset classes like private debt, so private debt is very similar to, I think, directly in almost directly comparable to investing in bonds, particularly in the direct lending strategy. So, you are lending to usually corporates, and oftentimes you are secured. So you know exactly your repayment schedule. It's quite predictable, and usually you're not doing, I mean, you can do very long-term loans, but I would say, normally something like 3 years and up to 5 years, and you know your schedule of getting your money back, unless there is a default situation, for example. So investors that allocate to private debt tends to really value this asset class as a reliable income stream. So you could see that on this chart here. I think private debt would be the bright blue. So you could see that's reaching quite far out to that. So and also in terms of inflation hedge as well. So investors tend to think of infrastructure and real assets, and also natural resources as a kind of approximate inflation hedge. So you could see that on this chart as well. It's just a very good way to see where what investors' main considerations are. So this kind of data, we get updates on it all the time. We do regular in surveys to investors twice a year, but this pattern doesn't really change. It tends to be a very representative, I think, data point in terms of what investors really think about and how they look at each asset class and what role they should play in their overall portfolio. Because a lot of investors would have, a public side of the portfolio as well. When we talk about the traditional 60/40 portfolio, you have 60% in stocks, 40% in bonds. That is slowly changing, but slowly. So right now, I would say alternative investments, even for the relatively active investors, normally it is a percentage of their portfolio, maybe something like I don't know, up to 20%. Rarely a lot higher unless it's someone like that has a very strong view on the asset class.
We have quite a long question here from Sam in Israel, and in fact, it's too long to actually show, so I'll read it out. But Sam says that there's research to show that private market funds in Israel oftentimes provide returns that are comparable or only marginally better than index funds. Given the higher risk associated with private market funds, do you think institutional investors should decrease the investment and put it more into safer index funds?
That is a very good question, Sam, and I think I know which article or study that you are referring to. Um, so I just want to point out that, whatever performance that you see out there, those represent the average performance of a pool of funds. So they might not really represent what exactly you would have access to, and the individual performance of each fund. If you look into the actual quartile distributions, you would find that there is quite a wide range of performance as well. But if we have to stick to just talking about the general idea, I would say that historically, looking at all the performance data that we have, private markets still outperformed the public markets in the long term. And I would say that when you put money into alternatives, you better have a long-term view, because it's not something that you can really expect to, allocate to one day and then 2 months later you decide it's a bad idea and you want to come out. When you do that, you tend to definitely lose a bit of money doing that, considering that you might be, selling your stake to somebody else at a discount. So you're really there. You have to be prepared to be there to stay in the game in the long run. And, while you might see some volatility, like I said, you in an investment for 6 years, of course, you're going to see some up and downs. And again, it is a risky asset class, you can lose all your money. That's definitely true, and I think nobody tries to downplay that at all. But at the same time, you could see very high investment multiples, which is why it is a riskier asset class. Rather than, I mean, the average performance is a good starting point to sort of think about, okay, roughly if I compare private equity to venture capital, okay, I'll get uh, on average, private equity would have a lower average net IRR, but also a smaller standard deviation. So then, therefore, as a whole, the industry as a whole, roughly, it's a lesser risk for less maybe more stable returns. But if you compare individual funds, individual assets, that might not always be the case. So I think a lot of investors now beginning to understand that and really try to do more due diligence in selecting fund managers, and some of them also going into direct investments. That really takes a lot of effort, a lot of time, a lot of knowledge to really keep track and think about which assets you want to go into, which markets, what strategy, how. I mean, you can gain access, you can gain exposure to the same thing via debt, via equities, but which one is better? I think at what time, that answer could be different as well. So I think I wouldn't I wouldn't necessarily make a very general conclusion as to, does that mean investors should not go into private? I wouldn't say that. And as far as I can see, investors are only becoming more interested in the private capital asset classes in the past. I think 5 to 10 years, it has really expanded. And I think, at least from Preqin's point of view, we give out our industry forecast. We still see a very positive growth for the industry in the long term.
Just a reminder to everyone, if you've got questions, please put them in the comments, and we'll come around to some. I can see some questions from Tim and Debasis. We'll come around to them later on in the show. Angela, you obviously with Preqin you do a lot of pulse checks with investors, etc. What are they thinking about at the moment? What are investors in private capital markets thinking of?
Yeah, I think it would be helpful if we go into another slide that I prepared. So what's really on top of people's minds right now? Again, just drawing on Preqin's investor surveys, because we do this twice a year, and it's a very good way to keep track of how people's preferences or people's concerns have changed. So I'd like to show you one chart here that where we ask investors, what do you think are the key challenges for return generation over the next 12 months? So here I show also the results from 2 years ago, that is in dark blue, and then the most recent one this year, that's in pink, because then you can really compare and contrast what has really changed. So perhaps not surprisingly, what's on top of people's minds right now, much more than 2 years ago, is rising interest rates. That's in the middle of the chart, and also the exit environment. So, these are all, in some ways, these are all interconnected, right? Rising interest rates, and then you have got interest rates affecting valuations, and that's affecting the market sentiment, appetite, deal flow. And if you have no deal flow, then you don't have a very good exit environment. And if you don't have a very good exit environment, it also means that maybe you start to get concerned about your assets. You also mark them down, and then nobody's investing in new investments. So in a way, they're all interconnected, but for sure, high interest rates, that is the one thing that is very much in the center stage since the beginning of last year. It's affecting, of course, public markets as well. You see that immediate impact on the bonds, on the stock market, and private capital just simply isn't immune to that. So we're seeing the impact also in this part of the world.
And in terms of the, is that also the case in that second, it's a chart on the right, where it looks like most investors or fearing a kind of correction, downward correction in the next 12 months or so?
That's correct. So with higher interest rates, first of all, it makes liquidity more costly, and so that tightens, liquidity in the market, and that affects deal flow because a lot of times deals need to be financed. And with less deal flow, like I said, you'd have less active transactions, which means that for some investments, when you maybe were thinking of exiting, maybe in this 1, 2 years, you need to reschedule that plan. Maybe you need to push it back, and that means that investors would be holding on to their assets for longer. Now, all of these things translate into an impact for asset valuations. So first of all, higher interest rates, it means in your cash flow model, you're going to have higher discount rates. So your cash flows are worth less in the present value. And also your financing costs would go up. And also, your company performance itself might just be affected by all the negativity in the market. So all of this is definitely a concern, causing negative pressure on asset valuations. And so we see this asset valuations concern being quite high. What's interesting is if we go back on to the left chart, you see that actually in these 2 years, asset valuations was a major concern anyway. But what's interesting is that I think the concerns were slightly different. Maybe 2 years ago, in 2021, the concern was that valuations were too high. That's because we had lots of money going into the space, and we had investors chasing deals. You see that in private equity, you see that in venture capital, you see it everywhere. But right now it's a concern because we feel like okay, asset valuation might be coming down. So we are monitoring a lot of that type of data here at Preqin, and we definitely see that. For example, information technology, private asset valuations still down by more than 30% from their peak in 2021. And if we look at venture capital are now having pretty high proportions of down rounds. So down rounds mean that when companies go for a next funding, they are seeing their valuations being cut compared to the last round. So that's valuation down rounds are now between 10% to 16%. It's quite it's quite a steep climb, I think, from let's say a year ago when it was just a very much a bull market across public and private. So now, yes, this chart is just showing that a lot of our respondents are saying that they feel asset valuations are a concern, and they think that what's in their portfolio now could be subject to some sort of a correction, either in the next 12 months or maybe even more immediate than that.
Tim has a question, which is about private equity and whether, he cites that historically there have been instances where private equity investors strip out assets, they take on huge amounts of debt, and it just didn't work out. It destroyed value for shareholders and employees. Do you think with the current environment, with higher interest rates, we're going to see less of that very highly leveraged kind of private equity investments and buyouts?
Okay, so maybe first of all, responding to that, I think at in any transaction, when an investor takes on a new asset, you want to create value out of it, right? If you just hold it and do nothing, and you sit around and wait for 2 years, it's not just going to go up because of that. You want to make a profit, so you need to do something to the asset to improve it, to make it more valuable for when you exit, right? Or if you don't, or let's say you're a long-term investor, you still want the company to be functioning better, to be performing better, to be returning more to the shareholder. So in doing that, financial leverage is something that is very common. I wouldn't say it's necessarily, it would be really difficult to say it's a bad thing. It just depends on how you manage it. Of course, um, too much of a good thing also could be problematic. And in terms of asset stripping, I mean, optimizing a company's structure, offloading assets that are maybe still costing you to run, but aren't bringing, this the proportional benefit to the company, to the shareholders. Again, that sounds right, to me. It's just how you do it, and whether you are really overdoing it, and whether that then becomes value creation or value destruction. That really depends on the individual situation, and I guess the investor itself as well. So I think if you have to be, I mean, if you have to look, I'm sure you can find cases where it's not done well. Um, but at the same time, you could also find cases where it's done well. Again, I'm saying that these investments, each one is very different. Each company is very different. The situation is very different. It's all very idiosyncratic. And therefore, each fund also performs very differently from another. So it's something that investors would have to try to understand and get a better grasp of.
You mentioned this current economic environment and it's affecting the deal flow. So, do you see changes in terms of how the funds are being raised, the fundraising side?
Um, yes, so um, I do have a chart on this. It might be a bit hard to look at individually, but I could just overall talk about it. Because for example, in private equity, like we said, investors are concerned about the overall um, exit as well as deal flow environment and valuations and all that. You can see that compared to the highs of 2021, which actually was a record fundraising year for private equity across asset classes almost. So compared to that, it's definitely moderated. But some asset classes are doing relatively better. So in 2022, we've got the infrastructure asset class taking in a lot of capital. Some mega funds were raised that were never raised before, and also private debt as well. That's definitely gaining a lot of traction. So private debt is a bit of an outlier here in the sense that when everyone else is concerned about the negative impact of rising interest rates, private debt is an asset class that actually benefits from it. And that's because a lot of private debt, especially in the more secured lending strategies, you have your loan pricing tagged to floating interest rates. So first of all, you are not as sensitive to rising interest rates. Your interest rate gets reset regularly, so you have less of that impact, which is unlike bonds, which is why bonds were quite heavily impacted whenever you have interest rates increased, because a lot of bonds are paying fixed coupons. But so that's not the case in private debt, first of all. And secondly, because of the weakening economic environment, you also have the more traditional lenders, the big lenders, the banks. They are pulling back on their lending appetite. So you have less competition out there, and private debt investors are just really stepping in to fill that gap. And of course, with the expectation that you'll get better returns than before. So, if I can just throw in a few numbers, the improvement that we're talking about would be maybe for secured lending, maybe last year. You're getting around 8% return, but today you would be getting something like 12% return, and that's really for the very secured lending part of the market. But private debt is also, it also has a pretty wide risk spectrum. You can also go deeper, higher up the risk spectrum. You could go into mezzanine, you could go into special situations, and you can also go into distressed. So those offer even higher returns, of course, at a higher risk. But if you think about that, if you start with 12%, you keep on adding that, again, at risk, at your own risk, you are looking at, returns that are very comparable to equity returns. And that's why we see that bit of pivot away from the equity strategies into the debt strategies. So that's all being reflected into fundraising right now.
Angela, we have some questions about regional differences. So the first one,
Oh
I
yeah.
think we'll take the first one from Debasis. He's got two questions, but maybe the first one, which is, how is the private equity market different in Asia compared to, we'll say, Europe and North America?
Yeah, that is a very good question. Because Asia Pacific, I think first of all, it is although it is a region, compared to, say, North America, really consists of very different markets. You have the very big piece, the emerging markets, and in that, China definitely is the heavyweight. And then you have the other markets that are developed, but relatively, I'd say, smaller, like Japan, like South Korea. So depending on the asset class, there are some differences. I would say that actually venture capital now is quite active in Asia. In fact, it has grown faster than markets in the West. And if you say venture capital now, actually more than half is in Asia Pacific. So it's actually you know if you look at transactions, and all that, it's actually becoming more active even compared to the US. So that's because Asia Pacific, especially in the emerging parts of it, there are still a lot of opportunities for some very, I would say, maybe more basic type of, still very fundamental growth opportunities. A lot of the emerging parts still don't have. I mean, they're still underbanked, for example. They still don't have very good access to like technology and like logistics wise. There's a lot of improvements to be done, and in the emerging markets, especially China aside, a lot of times they rely a lot on private capital investments and foreign investments. So that is one reason why they grow faster. And the other thing is, okay, another asset class, for example, we can talk about private debt. So private debt, the makeup between is very different if we think about Asia Pacific versus the more developed markets of Europe and North America. So North America, well, US, Europe, they are very developed markets, and in those places, yeah, private debt is already a very established sort of asset class. They have a pretty good market share. They kind of see eye to eye with the banks. But in Asia, it's not like that. In Asia, the lending space is still very much dominated by banks. So first of all, private debt is much smaller in Asia than the rest. Oh, so just now I said, venture capital Asia is one of the biggest piece. For private debt, it's the opposite. Asia Pacific is only 6% of the global private debt market. It's very small, but not only that, it's more geared towards the higher risk part of the market. So rather than competing with the banks because they dominate already the direct lending strategy, in Asia you have more sort of boutique, more niche funds in the special situations or in the distressed debt market, and they are very niche in their own sense because you have to really be on the ground to really understand and have that experience dealing with that sort of loan recovery situation. It's very country specific, and we have many of those countries. So each one is very different. The jurisdictions very different, and that's one of some of the differences that we see between APAC and the other regions. If that helps answer your question a little bit.
And Debas's second question is, what's the biggest opportunity at the moment in Asia? I think you mentioned a bit about those um opportunities where, let's say, it's in fintech, reaching the underbanked, etc. Are there other opportunities? What are the key countries that are driving a lot of that private equity investment in Asia?
Yeah, maybe I can talk about like what we know where we see the most active deal flow recently. So again, it depends on which asset class, which strategies you're thinking about. For private equity, in the last few quarters, we observed that Japan is a very active market, and it's kind of coming back from a bit of a low, maybe proportionally from a few years ago. And my take on that is that, well, Japan is traditionally known as a market that just trades. You can see it in the public markets as well. It just trades with a lower valuation. It's so it's more stable as well, but it also is not growing as fast, especially if you were comparing it to the emerging parts of Asia. So I think in these last few years, when China was really booming, and you've got the rising Southeast Asian, and and India as well. So at that point, I think Japan was getting a little less attention than the rest of the region. But I think now, as everybody tries to rethink their country exposure, a lot more investors are interested in Japan, because they see, okay, maybe returns are slightly lower, but also overall they tend to be more stable. So does slow and steady win the game? I think that's one of the potential considerations by investors. But also, of course, because of a very favorable yen, to the US dollar, that's definitely an added bonus. If you look at how much it has fallen just over a year, that's especially if you think about things like real estate, that's almost an immediate discount, that you could quite easily enter. So that's in terms of private equity, real estate as well. We see quite a bit of attention turning towards there. But if you're thinking about venture capital, then you've got I think right now when we speak to investors, and also from what we observe in our surveys, there's a lot of focus on India and Southeast Asia. We see that actually changed quite a lot. Maybe 2 years ago, within emerging Asia, China was always on the top of the list. But that's changed, especially since last year. So now investors are really looking into these markets. They are definitely smaller for the time being. They are less mature. I mean, they have less depth also, compared to China. So they come from a smaller base, but they also offer a lot of um, investment opportunities with a much smaller ticket size as well. So that's interesting right now to venture capital investors, because a lot of investors we see are trying to pivot to the earlier stage strategies where individual investments are smaller, so it's possible to diversify over more of them, as also a kind of risk management. But if you could hit the right ones, in these very emerging markets, in the long term, they could prove to be, interesting. So yeah, so those are some of the trends that we observe right now in Asia.
Muhammad has a question also on Asia, which is, do private market firms in Asia deal with leverage buyouts?
Absolutely. Absolutely. That is a core part, I think, of any private equity market.
Pedro asks, how do you compare the
Hi,
financial...
Pedro.
Oh, yeah.
It's from my class, I think.
Okay.
Yes.
So how do you compare the financial crime risks, such as sanctions evasion, money laundering, of investments in alternatives versus investments in public markets?
How do I compare the risk? I mean, ultimately, yeah, you are still investing in companies. So I think rather than the risk, you're probably talking about something like disclosure, and transparency. And I mean, this is a trick question, because undoubtedly, if we're dealing with a less transparent market, that is a risk that you would have to be very careful about. I mean, there's really no denying that. The only thing is that I think, around the world, whether it is from regulators or it's from the investors themselves, there definitely is a higher emphasis, and that's increasing as well on transparency, on due diligence, and on this sort of financial crime risk. So that's definitely a very important part of the due diligence process, and something ongoing as well, especially when we think about emerging markets. Of course, you know, generally corporate governance is not at the same standards as developed markets, and generally there's high risk of things like corruption, that sort of thing. So definitely it's there. It's a risk. Definitely when you're investing in any investment,
Mm.
I would say, but it is something to consider in private investments, definitely.
And Angela, I will ask the final question then, which is you've got more than 15 years of experience in um, investment analysis, risk management. You've obviously seen a lot, worked in different countries, recruited many people. What are the sort of skills and the type of people that you look for when you recruit into this part of the financial services industry?
Um, I think generally they are depending on the type of role, the type of field. I mean, it's also a very broad field. In private investments, you can be, if you're good at sales, you could be in the distributions, you could be raising funds, you could be in the investor relations. You could also be doing the deals yourself, so you could be on the deal team, you could be buying assets. And of course, you could also be like me. We do research, so we talk about more general research skills. Most of these skills, I think, you could acquire from experience in the financial markets. But some of them, I'd say, might require more specific skills. So, for example, if you want to be on the deal team for a healthcare fund, then obviously, with some knowledge, with some expert knowledge in the field, in very specific fields, that would definitely be an advantage.
Mm. Well, thank you so much, Angela, for that. And I'm sure people are now brushing off their CVs and going to send them over to you.
Thank you very
Yeah.
much. I'm really pleased with a great turnout,
Mm.
and this is a great show.
Yeah. Thank you so. Now, the balance sheet will be back on the 27th of October. We've got Professor Simon Learmount, who will talk about corporate governance and the role of corporate boards. What do boards do? What do board directors do? And should you try to get a board directorship? So if you can, join us then, same time, 12:45 p.m. Till then, thank you so much. Stay well, and we'll see you next time.